Assalamualaikum warahmatullahi wabarakatuh. We are from group that consists of me, Yasmin Luxia, Valia Zakira Utami, and Nadia Alia Fitri. We will talk about return on invested capital and profitability analysis. This is the study map that we will talk about. You can read it by yourself. So the first topic is the importance of return on invested capital. Return on invested capital in several areas of our analysis. We can use it for measuring managerial effectiveness. Return on invested capital, especially when computed over intervals of a year or longer, it is a relevant measure of a company's managerial effectiveness. So we can look to the return on invested capital if we want to measuring managerial effectiveness. And then ROIC also can use for measuring profitability. Return on invested capital is an important indicator of a company's long-term financial strength. It uses key summary measures from both the income statement profits and the balance sheet financing to assess profitability. And then we can measure for planning and control. This is the component of return on invested capital. If we want to calculate the return on invested capital, the general formula of ROI is income divided by invested capital. This is the indicator of the formula. First, we need to dividing invested capital. There is no universal measure of invested capital from which to compute rate of returns. The different measures of invested capital used reflect users' different perspective. So this is the type of invested capital in a company. We can use the long-term debt or current liabilities or revert equity or common equity. This is and the second is we need to determine the net operating assets. Many analysts segregate the balance sheet and income statement into operating and non-operating components and compute a return on net operating assets or RNOA as the summary measure of performance. So in this net operating asset, we should determine the operating and non-operating component first. After that, we can compute the RNOA. And then there are common equity capital. Common equity capital or return on common equity, or we call it ROCE, is defined as net income less preferred dividends divided by average common equity. Common equity is equal to total shareholders' equity less preferred stock. Preferred stock is excluded from the computation since from the viewpoint of common shareholders. Preferred stock has a fixed claim to the net assets and cash flow of the company, just like that. Common equity can alternatively be defined as equal to total assets less debt and preferred stock. And then we compute the invested capital for the period. The invested capital for the period is typically computed using the average capital available to a company during the period. And average is used to reflect change in invested capital during the period. The most common method is adding beginning and ending year invested capital and dividing by 2. Then there are adjustments to invested capital and income. Many accounting numbers call for analytical adjustment. Also, several numbers not reported in financial statement need to be included. And then whatever their impacts, the analysis of return on invested capital should use the appropriately adjusted financial statement number. So we need to adjust the appropriate financial statement numbers. And then after all the step is done, we can compute the return on invested capital. So I have an example related to calculating return on invested capital. This is the this is the Excel corporation. As you can see, this is the income statement, and you can see all the numbers by yourself. And the net income in year 8 is 80,943, and in year 9 we got 104,148. This is first we need to determine the return on net operating assets. The formula is net operating profits after tax, or we call it NOPAT, divided by average net operating assets. This is the balance sheet, the template of balance sheet, as you can see. So net operating assets come from the operating asset less operating liabilities, and net financing. And then in the right side we can see the financial liabilities less financial assets. We got net financial obligations, and then we less the net financial obligations with stockholders equity, and then we got net financing. So the formula of net financing is net financial obligations plus, I'm sorry, it's plus stockholders equity. So this is the balance sheets of Excel Corporation. As you can see it by yourself. So as we talked before, we need to compute net operating asset first with calculate all the assets like cash, account receivable, inventories, investment, property, goodwill, account payable, tax payable. And then after we got the net operating assets as the formula, we need to find the net financial obligation, and we calculate all the obligations related to the financial obligation, and then we got this number, as you can see. And then we can finally calculate the net operating asset with calculate the net of net financial obligation plus stockholder equity. As we know, we already got the net operating assets, and we want to find the stockholder equities, and then we can adjust the formula, and then we got this number. And for the income statement, we can see this is the template of income statement. So we also need to compute the notepad. As you can see the formula, and for this example we got the notepad is for year 8 is 102,993, and year 9 we got 117,488. And then we got the return on net operating asset notepad divided by average NOA, we got 9.95%. As I said before, the average of NOA, we need to divide it by the number of the year that we calculate. For this case, we calculate for 2 years, so we divided it by 2. And then we also can find the return on common shareholders equity with this formula: net income minus preferred dividends, and then divided by average common shareholders equity, and then we got the total is 14.46%. So that's all for me. The next slide will be explained by Nadia.
Recording in progress. Now I will continue this presentation, so I will explain more about analyzing return on net operating assets. So return on invested capital is useful in management evaluation, profitability analysis, and planning and control. When invested capital is built from an operating standpoint, it commonly referred as return on net operating assets, or NOA. Next, I will talk about disaggregating return on net operating assets. So the return on net operating asset, or NOA, is computed by the net operating profit after tax, or NOPAT, divided with average net operating assets. So as you see in this slide, this is the disaggregating return on net operating assets. We already know the curve, how to get the return on net operating asset, and then I would like to give more explanation about this. So the return on net operating asset can be calculated by NOPAT margin times net operating asset turnover, or we can say that NOA turnover. For the NOPAT margin itself can be calculated by NOPAT divided by number of sales, and for the NOA turnover can be calculated by sales divided with the average NOA. This is for the first level, and about the calculation of NOPAT and NOA turnover. For the second level, NOPAT can be calculated by the number of sales minus cost, the total cost. In in this slide, you can see that there are three types of cost. The first is cost of sales, selling expenses, and administrative other expenses. And for the average NOA, it can be calculated by the net operating working capital plus long-term net operating assets. For the net operating working capital can be calculated by we have to add cash, receivable, inventories, and other short-term operating assets, and then we have to reduce it with the payables and also the other accruals. On the other hand, for the long-term net operating assets, we have to calculate the PPE assets plus intangible and other long-term operating assets reduced by the pension and OPEB liabilities and then other long-term operating liabilities. Next is about relation between profit margin and asset turnover. So in this exhibit 8.4, it's about analysis of return on net operating assets. The return analysis of exhibit 8.4 to show a continuous range of possible combination of profit margin and asset turnovers, yielding a constant return on assets. We will discuss in detail in the exhibit 8.5. So in exhibit 8.5, we already see that there's a curve about relation between an operating margin and OE turnover and return on net operating assets. This data also according to the previous data in exhibit 8.4. This curve portrays this relation between an operating margin in the horizontal axis and also the NOA turnover in vertical axis. This curve down in trace all the combination of an operating margin and an operating turnover, yielding a constant return on net operating assets. The curve slopes from the upper left corner of low NOPAT and high NOA turnover. Yeah, I mean this point. And then to the lower right corner of high NOPAT margin and OA and low NOA turnover. Yeah, I mean around this one. Next, we're going to talk about analyzing return on common equity. Return on common shareholders' equity, or ROCE. In simple, we can say that return on common equity is one of greatest interest to the shareholders of the company. The relationship between return on shareholders' equity and return on net operating assets is also important as it bears on the analysis of the company's success with financial leverage. So you can also see that the formula of the ROCE, we can calculate it by PT equals to BVT plus NIT plus 1 minus K times BVT, and we have to divide with 1 plus K, and then plus NIT plus 1 minus K times BVT plus 1, and we also divide it with 1 plus K squared, and plus blah blah blah, and so on. The formula can be restated in terms of future returns on common shareholders' equity. The formula is PT equals to BVT plus ROCE T plus 1 minus K, and we have to multiply it with BVT, and then we also have to divide it with 1 plus K plus ROCE times 2 minus K multiplied by BVT plus 1, and at the end we have to divide it with 1 plus K squared, and so on. In this formula, BV stands for company value, and BV stands for book value of stockholders' equity, and I stands for net income. K stands for cost of equity capital, or we can say that the return that shareholders expect to earn on their investment. According all this formula, it implies that company with expected ROCE greater than the investors' required rate of return increase value in excess of the implied book value. The next slide will be explained by Paula.
Describe this aggregation of return on common shareholders' equity and development of its components. While ROCE in the above formula is computed using the beginning of period balance of common equity, in practice we use the average balance for the period under analysis. As with return on net operating assets, these aggregating returns on common equity into components is extremely useful for analysis purposes. Recall that the return on common shareholders' equity is computed as net income minus preferred dividends divided by average common shareholders' equity. We can disaggregate return on common shareholders' equity to obtain ROCE equals RNOA plus LEV multiplied by spread, where RNOA is the return on net operating assets, and the second term, or LEV spread, is the effect of financial leverage. The first component of the financial leverage effect is the degree of financial leverage, or LEV, measured by the relative amounts of net financial obligations and stockholders' equity used by the company to finance its net operating assets. Then the second component is the split, the return on net operating assets, or NOA, less the net financial return, or NFR, where NFR is the average net return on financial liabilities and assets. NFR is computed as the net financial expense divided by the average net financial obligations outstanding during the year. Financial leverage increases ROE so long as the spread is positive. Simply put, if a company can earn a higher return on net operating assets than the cost of debt that finance these assets, the excess return accrues to the benefit of its shareholders. Return on common equity, or ROCE, consists of both an operating component and a non-operating component. This operating and non-operating distinction is important for several reasons. First, the vast majority of companies provide goods and services to customers as their primary business. The second, operating activities have the most pronounced and long-lasting effects on company value. And last, although companies can realize and invest in ROE through judicious use of financial leverage, like debt payments, or interest and principal are contractual obligations that must be met in good times and bad. Next, explain operating and financial leverage and how to assess a company's success in using leverage to increase returns. Key concept: operating leverage and financial leverage both tell you different things about the company's financial health. And operating leverage is an indication of how a company's costs are structured and also is used to determine its break-even point. Next, financial leverage refers to the amount of debt used to finance the operations of a company. This is the comparisons between operating leverage and financial leverage. The first, in terms of meaning, operating leverage can be defined as a firm's ability to use fixed costs to generate more returns. Meanwhile, financial leverage can be defined as a firm's ability to use capital structure to earn better returns and to reduce taxes. And what is all about? Operating leverage, it's about the fixed cost of the firm, and financial leverage about the capital structure of the firm. And in terms of measurement, operating leverage measures the operating rates of a business, and financial leverage measures the financial rates of a business. In calculation, operating leverage can be calculated when we divide contribution by EBIT on the firm, and financial leverage can be calculated when we divide EBIT by EBT of the firm. The impact: when the degree of operating leverage is higher, it depicts more operating risk for the firm and vice versa. And when the degree of financial leverage is higher, it depicts a more financial risk for the firm and vice versa. And in relation with the degree of operating leverage is usually higher than break-even point. And financial leverage has a direct relationship with the liability side of the balance sheet. And last, how much it is leverage. Operating leverage should have lower preference, and financial leverage, the preference of it is much higher. Leverage is the strategy of using borrowed money to increase return on an investment. If the return on the total value invested in the security or your own cash plus borrowed funds is higher than the interest you pay on the borrowed funds, you can make a significant profit. And while leverage doesn't change the percentage rate of return, starting with 100 USD and ending with $115, and starting with $1,000 and ending with $1,150 instead of 15% return in both cases, leverage can increase the total dollar value of return. A return of $15 is significantly less than a return of $150. The leverage ratio is defined as the number of dollars being borrowed for each dollar being invested. The most common of leverage for an individual investor is home mortgage. Most investors use a home mortgage to fund the purchase of a home with a standard down payment of 15 to 20%. Leveraging a home purchase is in fact so common, since home prices over decades are generally non-volatile, or the housing bubble of 2008 notwithstanding. All types of investment, buying stock and margin, company expansion, leverage buyouts, and hedge funds employ leverage, and all of these investments work on the same principles in the above examples. They all have leverage ratios and imply the effect of gains and losses. The more leverage, the greater returns can be, but losses can be larger as well. Leveraging your investment essentially makes the return more volatile, and if you can stomach the risk, don't bother. If you own less risky investment than only individual stocks, it makes a little sense that to lever your investment. If you want to up risk in your portfolio, why not just take a smaller step and adjust your equity allocation upward? If you feel particularly storing about a particular stock, you can invest in a lead, which may provide the upside of leverage when returns are high, but may allow you to avoid paying out additional principal if the investment goes up. That's all of our slides. Thank you for watching.